Time now for our 2-minute drill. Joining us now, Nicole Webb, Wealth Enhancement Group Senior Vice President. Good to see you. Before we do some stock picking, I'd like to get your view of the market here and now. Where do you think it's going from here?
We think there is going to be a continued trickle-through effect of both interest rates and inflation. We don't see this forecast where we're at the forefront of the beginnings of an easing cycle. We think that's a ways out, and that the Fed is going to continue its vicious attempt to slow inflation and hopefully bring prices back down to a manageable place before we go into a profits recession.
Do you feel we're at risk of going back to the lows, or have we come too far to go back quite that far?
You know, I think there's still such a demand in this inflationary environment for the yield we're seeing from the flexibility and the nimbleness of balance sheets of strong corporations. So we're seeing a lot of flows into aristocratic stock positions. So it's a little bit of a self-fulfilling prophecy at this moment in time. So perhaps not those lows, but we do think that we are going to see continued adjusted expectations on a go-forward basis, and that we may very well push ourselves back into a problem territory. But all of that said, lots of buy opportunities beneath the market surface right now as well.
Let's talk about some of those. Nike is #1 on your list, at least on my list from you. I think, you know, obviously there are economic challenges that come into play here, and certainly China. So why now?
Yeah, I think a lot of the backdrop of the economic environment we're in has already been priced down. I mean, if you look at the share price year to date, we're trading now at 108. Roughly. When we think about their business momentum, brands like Jordan, Converse, and then also the thing that excites me the most about Nike is that they not only have a full price purchase model, but also they've already adopted a 40% of their business is done through e-commerce, which excites us on kind of that forward movement. So we think that this backdrop is already priced in, and we think they have the potential both in innovation and e-commerce to prevail the retail landscape go forward.
Healthcare is popular among a lot of people these days for obvious reasons. Merck is on your list.
Yeah. I think it's a completely underappreciated 120-year-old company. And when you look at it trading at 12 times forward earnings with a 3% dividend, yeah, it's had a great year so far. But we think that a lot of that is from the defensive posturing. We also think from a free cash flow perspective that they can actually weather the storm of going off patent with their namesake drug. And we think their innovation pipeline is strong. So again, we like where they are, and we think it's a great long-term hold for investors with a decent purchase price today.
And quickly, Ferguson, why that one?
Yeah. Oh, I love it. It's our outside of the box growth on sale pick. This leading distributor has a lot of potential, and it's under the radar for most investors as they just de-merged from their European operations. Their free cash flow, their balance sheet liquidity, even if there is an economic downturn over and above what we've seen in the contraction in housing, we're seeing 60% of their sales actually in maintenance and repair. So we think that they won't behave as cyclically as others in this landscape. And in terms of tailwinds, we actually think that there is just simply an underdevelopment of single family homes. And so we think it's a great value purchase today.
All right.